Let's welcome in our next guest. We have Mr. Pankaj Sharma. He's a market analyst joining us now. Mr. Sharma, thank you so much for being with us on NDTV Profit. Now, people want to, in this festive time, not really look much at the markets. They're not doing much. They want to look ahead, say, starting the next calendar year in January. Do you think the markets are preparing for an up move, or is this the calm before the storm? Could we see a breakdown? Because next the market's going to be watching out for global factors and for the budget. Do you think there are positive triggers for the markets?
Unfortunately, I don't think that anything meaningful in terms of positive triggers could really happen in next 1.5 months, at least till the time we see the next budget, because that would be the document that would give an indication how the government want to focus on the perceived slowdown, especially as a result of demonetization. But as far as global factors are concerned, I don't think the tide is going to turn anytime soon. And that is something which is not a great news, because even in last, let's say, if we see 1.5 months, the primary reason, despite a lot of buying which has happened by domestic mutual funds and institutional investors, things have not really moved up. And the primary reason is that the foreign investors are still not very convinced. And I don't think that picture is going to change immediately. Next couple of months, or at least 2 to 3 months, it looks very unlikely that we might see a change in sentiment from FIIs. And that actually means that it's extremely unlikely to see any kind of up move in the market. On the downside, I think it depends on how this demonetization thing plays out. There are signs that things might look slightly better in next 15 to 20 days. And if that happens, probably the negative sentiment which is around the companies which are directly getting impacted from this phenomenon probably is going to get slightly better. But overall, I don't think the view looks that positive on the broader markets in next 1.5 to 2 months.
Then what levels are you watching out for on the Nifty, and what should investors do? Should they look at accumulating stocks if you think that the markets are going to be giving them good returns in the medium term?
See, I think it's a kind of paradox, because what we see in last at least couple of years, every time there is a correction or markets have not done well, there is a hope and there is an expectation that things would look better in next 6 to 12 months. And this has been the phenomenon for last almost 2.5 years, starting April, May, or even earlier, March, April 2014 until now. We have not really seen any significant change or any significant move up in the broader markets. Of course, there would be stories in individual stocks which have done well and which continue to do well, but they are very localized phenomenon. But for broader markets, I think the story has always been that in next 6 to 12 months, things would start to look better. I'm not really very convinced about this. I think that things are going to get slightly more difficult in next 6 months, because third quarter numbers and especially the fourth quarter numbers would have an impact from demonetization, which is going to be significant, at least in the sectors which are directly dependent on this. So if you see many of these SMEs, unorganized sectors, it's something which is getting more and more impacted, and you would see the phenomena in earnings also, when especially cases like FMCG and durables, you would see that impact is there. So earnings recovery is unlikely to play out very soon, and my best guess is that at least next 6 months we are not going to see any meaningful recovery in earnings, and that means that it's very difficult to see why market should start to do well. As far as the levels are concerned, I think in next 2 to 3 months, I believe that is going to be a case where I would say there is a 70-30 chance that market might fall a little further, and it means about 5 to 7% kind of correction we might see. On the upside, I'm not really very convinced. As I said, like 30% probability only whether market will move up, but it's not going to be that significant in my view. As far as the individual stocks are concerned, I think it's a dependency on how things would play out in broader sectors. Especially, I think that at least in terms of relative basis, things are looking slightly better for IT. I think this is a sector where the fear of bad news as a result of Trump getting elected, US President, and the resultant impact which will come on H1B, etc. I think companies are taking proactive measures. When I talk to many of these companies, I get a sense that they have already started to address this issue. And the levels where we are, I think it's not going to be a sector which would outperform in, let's say, 12 months horizon. So I think that is one sector which I would keep an eye on. Other than that, I think the broader sectors like power, infrastructure, these are the core sectors. I think they are relatively better at this point because we are not seeing any significant impact on demonetization other than the contractors which are playing a very important role for the EPC companies. But overall, I think things are not looking that great for at least next couple of quarters for FMCG and other related sectors where we are seeing the impact of demonetization like autos.
All right. So you're not expecting earnings to look up in the next 6 months. Do you think the valuations at which the indices are earning is reflecting that? Because you said that there are some sectors where earnings will be severely impacted, but there are others like maybe even metals, you can add to the names, IT, that may not see very poor earnings. When it comes to valuations, are they reasonable?
See, I think valuation, as we have seen, let's say if we look at, again, I'm coming back to the IT. In last 12 to 18 months, if you just draw one conclusion on how these stocks have performed, I think there is a clear indication that this sector has not really got or helped by valuation support. Valuation has been extremely supportive almost for last 12 to 18 months, but things have not really played out that way. So first of all, earnings support is very, very important, and this is what the investors believe, especially equity investors. They would want to have the first preference is for, of course, a revenue growth, and if revenue growth is not coming, then earnings growth is preference. And the last thing is valuation support. So for broader markets, valuation support is important, but when we look at individual stocks and when we look at sectors per se, valuation supports at time really don't help that much. So my sense is that, of course, we need to see a meaningful earning recovery across the board in 6 to 12 months, then only the market will move up. Especially if you look at some of these sectors which you have highlighted, I think things are looking, as you rightly said, that things are looking slightly better on maybe metals and slightly better on maybe even the recovery of oil prices as well. But overall, I think that we are at a level where it's very, very difficult to say that this is going to continue for a very long time, because metals anyway the sector where a lot of global factors are at play and things are still not very, very clear how they will play out. So my sense is that if you get earning support from the sectors which are primarily domestic consumption based stories, is always preferred by investors. Investors like it much more than the recovery which is probably coming in sectors which are more influenced by global factors and the sectors like metal. So I think this is something which is a slight difference between where earnings recovery can help the markets, and that is something which I see is going to be very, very important in the investors' mind before they take a definite call on how they want to trade these sectors.
Right. Pankaj, how would you look at the flow picture and what happens with the global rates? Say if rates were to come up further, or we can say the yields were to strengthen further globally. Do you think it will be a big risk-off trade, or this time around our forex situation is fine, the growth everybody knows, or expectations are not that high for growth, so it may not have such a material impact?
Yeah, I agree. I think things are, at least in domestic terms, is not going to be very, very challenging situation. We are more or less okay in terms of our reserves, in terms of how this could impact. But I think one thing which we need to keep in mind that the global rates are much more a sentiment driver than the real impact you would see in tangible terms on countries like India. So what happens that whenever you see an expectation that Fed is going to be more hawkish, how they want to increase rates in next 12 months, that plays a very, very important role in the minds of foreign investors. They think that why bother with the stories where something as unpredictable and as drastic like demonetization can happen. And that is something which people probably get a bit concerned with. They say that, okay, fine, this is a situation where I can very well trade the developed markets. I am very, very good with that. So why should I even bother with how emerging markets like India would be doing? Because there is an inherent risk in terms of policy making, which they are not very sure of. So overall, definitely tangible impact, I really don't see that much. But would sentiment remain as positive as it was maybe 12 months back or even 18 months back on emerging markets? I'm not really very sure and convinced about that.
Right. In terms of the flow here on the domestic side, that seems to be strong. Do you think that will support the market, or it's always a function, returns, flows, returns? So if returns are not coming, maybe even domestic flows dry up.
So I think it's a very good point. I completely agree, Pankaj, because I think we have seen this in last 1.5 months, and even I would say that a large part or good part of last 12 to 18 months that domestic flows have definitely supported the kind of falls which we have seen. It could have been much worse the way FIs were withdrawing from the market. But it's again chicken and egg story. If you continuously see that the market is not performing, the market is not really giving the returns you are supposed to get or you are expecting, then definitely there is an impact on flows. However, I think there is a slight difference now. The other investment avenues have become slightly more challenging. So when you see what an average investor would have options with, one probably is real estate, then gold, then you have the fixed deposits and other instruments which are assured returns. So compared to all these instruments and compared to all these avenues, you might think that, okay, it's still better to take chance with equities. Anyway, I really don't see anything significant happening in the real estate market. Gold anyway is not going to do very well because people are really scared in terms of adding it more. And then you are seeing that interest rates are consistently coming down. When you see the fixed deposit rates and when you see the fixed return instruments, we have seen at least a 120 to 150 basis points decline in last couple of years. And that is making it a little more probably favorable situation for equities. So it might continue for some more time, but yes, unless you deliver returns on a 12 to 18 months time frame, people would say that, okay, fine, equities are also not working. So let me set my expectations versus how the market has changed, how the other investment options have changed.
How would you look at the valuations on a total in the market? So you said at the start of the answer that Q3 and Q4 is going to be weak. But FY18, do you expect a lot of downgrades to come, or because it's uncertain, markets will not price in FY18?
See, market would start to price in FY18 maybe in a couple of months' time. As we move to February or March, people would have to talk about and discuss FY18 valuation and how they would look like, because you really don't have a choice. You can't say that I would move to FY17 actual. That's really not a possibility. It's not how the market would work. So it might remain uncertain, but people really don't have a choice. They would have to discuss and talk about how the FY18 numbers would look like. My sense is that in terms of how the first half would look like for FY18, there is still a lot of uncertainty, and that is something which will be very important for people to probably go for downgrades and maybe some corrections in the earnings. But second half, probably things would be a bit more normal. And once you see a normalized situation in overall basis, probably FY18 might not look that bad, because expectations and investors' view on how the earnings would look like has already come to a level where things are really not very optimistic and things are really not looking very gung-ho. So overall, I think that at these levels, considering the uncertainty we have in next 6 to 9 months, is very difficult to take that call. But versus expectation, I believe that FY18 might not look that bad, and that means that probably second half of CY17 or 2017 might be a bit better than how we are seeing the next 6 months.
Right. In terms of something like a IT, which you mentioned briefly that the fear factor is low considering the valuations, or with what is happening into US, that's the only big fear. But earnings changes over there are not quite material, or you don't expect a lot of earnings downgrade. Plus valuations have already derated. So again, the scope of derating is also low. Even if negative news flow comes in, downside on these stocks would be limited.
Yeah, I agree, because I think that if you see that what market is expecting from these companies in FY18 is something which is very basic, and despite everything which is happening in terms of sentiment, how the number of H1 visas would be reduced, whether the next US president would allow these companies to continue to hire from other geographies, despite all of it, if you see the net impact on earnings is not going to be that huge. And irrespective of, I would say that top 4 or 5 names, if you see, I really don't expect that possibility as a huge differentiating factor between how people would trade these stocks. So yes, there are 2 factors in favor. One is earnings are not going to get that impacted negatively. Secondly, in terms of valuation, as you rightly said, that it's a good support. These stocks are trading at valuations which are almost in all the cases historically lowest and very, very cheap. Only thing probably that might happen is that unless you see a bit more clarity, valuation has ceased to remain a support, but further downside is not really expected. I really don't expect Infosys to maybe go below 900 or maybe HCL to correct another 10%. So those kind of things might be a bit more acting as a support or as a help for these stocks. But yes, at some point in time, investors do need clarity and a bit of certainty on how things would play out. But yes, valuation has been a good support for these stocks.
Right, and that's why you believe that even if earnings were a miss or some negative news flow come in, after a correction, they would become very attractive, right? They are companies which are generating free cash flows. They don't have debt issues. They are independently managed versus the promoters. So a lot of positives also would come in once they see a correction.
Yes, I think if you see that how this is very interesting, because if you see that Infosys has seen the levels 920, 930, and then you have seen a lot of support, a lot of buying support came in these stocks, and you really could not find any external factor, any internal factor for these companies, how things have become better. So I'm not saying that 920 to 1000 or 1010 is a huge move, but it's still significant in a market like this. A 10% return is not that bad. So at some point in time, you start to see that, okay, fine, things are not really looking that great, but these stocks are, if they are trading at 13 times or 14 times, that is not really a bad price for these stocks. As you said, that management is good, you have a lot of comfort on corporate governance, you have a lot of comfort on cash situation of these companies. These companies are not going to go out of business as we have seen in some other sectors like infrastructure and construction. So this is a very, very safe sector as such. Yes, that's a problem in terms of how things would look like on macro uncertainty and earnings growth, etc. But at some point in time, you say that, okay, fine, these stocks have priced everything in. All the negatives are priced to an extent, and then let me just buy them a bit more. And that is what has happened in last maybe 1.5 to 2 months on these stocks, especially when we see the performance of Infosys.
Right. What do you make of some of the oil and gas stocks, exploration as well as oil and marketing companies? Now, crude oil prices are headed higher, and the OPEC deal will start kicking in from the month of January. Do you think there is a play in any of the exploration stocks? Do you think the likes of Reliance, Vedanta, Kane, all of these can see better days, better earnings ahead?
I think it's because when we see last 15, 20 years, whether the commitment to make production cuts has actually played out the way people have agreed upon this, or the major producers have agreed upon that, is not really very, very strong reason for us to believe that this would play out like this time around. Because oil prices are at a level where many of these countries are facing a lot of internal challenge and a lot of internal issues. Even if one country goes back on its commitment in terms of cuts, it might lead to a situation when everybody else will follow. So anyway, $55 or so is not really a price where you would see that oil would look better. But there is an inherent risk. So whether I would see, let's say, if you ask me whether in next 3 months' time, do I see a possibility of oil at 45 and do I see a possibility of oil at 65? I would say that 45 is 75% chance and 65 is only 25% chance, which actually means that when we look at many of these stocks, and let's say coming back to the Indian oil and gas space, things are really not, if, of course, let me probably put it a little differently, that if you want to take a bet on oil stabilizing, it doesn't really make sense. But if you want to see that we are at a level where these stocks, even if oil touches 45, they are fine, and you do your due diligence and you look at individual stocks, I think that might make much more sense. So buying these stocks and buying this basket on the hopes that oil has stabilized and production cuts is the only reason for you to buy them, I probably would not advise that.
What about the oil marketing companies? They've had a very good run over the last 2 years. Do you think they're good for more? Because now, they pass on the increase in crude oil. They're expanding their capacities. Their networks are strong. But they've run up quite a lot. So what do you do with oil marketing companies?
See, OMCs, I really don't see a problem with them for at least till the time oil is at 75, 80. So I think oil marketing companies are relatively better placed. I see that there are a lot of internal efficiencies which these guys are working on, and I know it for a fact, and a lot of personal interaction I have had with many of these guys. I think it looks slightly more optimistic, because in next 4 to 5 years, you might see that these companies are actually becoming more efficient in terms of their internal processes. When I talk to many of these guys and when I interact with many of these dealers which they have, they say that internal processes have actually started to change for better. And that is something which is going to be an important factor. If government stays away and government really does not interfere with the product pricing, I really don't think that these companies are a bad bet, because compared to many other options, especially in the oil and gas space, this is a pack which is better. I would probably think that maybe BPCL and followed by HPCL, it still looks okay. They have done well in last couple of years, but still they are not at a level where if things work favorably for them internally and oil is at a reasonable level, things would be fine for them.
Right. You've been looking at infra for really long, Pankaj. What is the view on, say, something like a L&T? Do you think the pace is so high that a good growth or a very big growth is not expected?
Yes, I think this is a call where at times I have gone horribly wrong also, because when, if you remember, like the stock is at around 1150 at 1200, my expectation was that it might fall a bit further, but it has done well, and of course a couple of results helped. The point that you are at a base today where it's very, very difficult for them to deliver a phenomenal or super normal above average kind of number, either in terms of order inflow or in terms of execution, is virtually an impossibility. And that really has a situation where if you see the valuation, if you see the L&T's stock price performance, I think most of the times the stock has done well because you really don't have too many alternatives. And that, I'm not saying that it doesn't apply today, it applies today also, that you really don't have many alternatives to L&T in this space. But from company's standpoint, do you expect a return either in terms of earnings or in terms of next 2 to 3 years execution and order inflow, which would surprise you positively? It's very, very unlikely. And that's why I believe that it's a stock which would always have some preference in the investor's mind, because you really don't have anything else. But from company's standpoint, and do you expect something which is way above the expectation and what they have done in last couple of years, is very, very difficult. And especially in some situation, let's say when we talk about this SME space and when we talk about unorganized sectors, a lot of these subcontractors which people work with, a lot of the real estate guys, because you see that the proportion of order book which is into factories and buildings and real estate construction has increased significantly for L&T. Also the overseas order book, those situations are really not going to play out as well. We have seen already the impact on real estate guys. We have already seen impact on some of these small contractors. They really don't have people who can continue to execute and continue to work because of temporary issues. It might get sorted out in 6 months' time, 9 months' time. That's possible. But the time lost is gone forever, and you are really not going to see that it's going to come back. So my sense is that if you ask me that whether you have a possibility of L&T correcting 10%, 12% is possible if there is a bad result. So when third quarter numbers come out, you see that L&T has not done as well as you were expecting. I really don't rule out the possibility of a 10% correction in the name.
Right. Is cement a better play than L&T now to play the India story?
Yeah, relative basis, yes, because cement is also a sector which has not done that badly. In last couple of years, we've seen that there is a lot of interest in this sector. But on a comparable basis, I think it's still a better play. You, of course, have a lot of demand that is going to get impacted from real estate construction as such. But overall, we are really not going to see too much of a problem in terms of how the macro would look like. So I think compared to an L&T and compared to many other infrastructure names, I would still think that cement is a better bet. And if you look at some of these stocks where you are comfortable, then definitely it's a better play.
Right. There are, earlier the view was that L&T, SBI, they are play on India growth story. Now you've ruled out that L&T, could probably do as well as say if the growth continues. But cement relatively better. How would you look at SBI or any other big PSU bank? Should that be a better way to play? Because a lot of negative news flow is already behind us. Do you believe that?
See, I think one part I agree, what you said towards the end, that a lot of bad news is already in the price. People know the kind of problems you have in this space. But when you see that the pole position which an SBI is in today, or maybe when you see 10 years back, that is deteriorating continuously. And there is not going to be a reversal. I'm really not very sure whether SBI, despite all the investments which they are making in IT, in their internal processes, and also the merger of some of the associates, everything combined, if you see, still is not going to be a case for you to argue that the tide which is in favor of private sector bank is going to turn. So when you look at India's story, why not even autos? Autos is very well in India's story. So when you look at something like Maruti, if you argue that Maruti is an India story, I think I really don't have a disagreement on that. But does SBI classify in that? Does PSU banks classify in that category? I think that next 5 years' time, next 10 years' time, you are going to see that these guys are going to continuously lose market share. These guys are having problems in terms of what has happened in last 5-7 years, and that would make their growth plans, their strategy to be a bit more conservative. They are not in a position to take very aggressive bets on expansion, very aggressive bets on how they want to grow their portfolio. And that's why I believe that despite bad news in the price, despite we know a lot of bad things about these stocks, it's very, very difficult to argue whether these companies can be actually classified as great India stories as such on a long-term basis.
Pankaj, thank you so much for taking out time for us. Always a pleasure.